Well, we want to welcome you to this program of the University of Arkansas Small Business and Technology and Development Center. We're very, very pleased to be able to bring you these educational programs and that support small businesses like yours in the region and the state. Please be advised that we will be recording this workshop for ASBTDC education purposes. I will introduce our presenters momentarily. In the meantime, I'm Amy Robinson, and I'd like to introduce my co-facilitator, Chris Case. We are specialty consultants with ASBTDC. If you are not familiar with ASBTDC, it is a one-stop shop for startups and existing small businesses. We're affiliated with the statewide ASBTDC, as well as a national network of more than 1,000 small business centers. So basically, you can go anywhere in the country and there is an SBTDC or an SBDC somewhere near you. Locally, we offer free one-on-one consulting, and that includes training, research, consulting, in one-on-one advisory services. We also produce programs like this that is relevant to small businesses. If you are not already a client and benefiting from our services, we encourage you to visit sbtdc.uark.edu, and we will be posting links on how to stay in touch with us as the program goes along today. Chris, will you tell us a little bit about how everything's going to work today?
I sure will. So you're going to notice that when you logged on, you are on mute as you arrived. And as a workshop, we do encourage you to answer or ask questions. But what we're going to have you do is ask the questions in the chat as we go through this conversation, and we'll try to answer them, or you can answer each other's questions. Feel free to do that. And then at the end, we'll leave time for answering your questions. So at the end, you can unmute and ask your questions personally, or you can place them in the chat, just like you're doing throughout the conversation. But please, we do love that you ask as many questions as possible, and we will get to those as needed. Absolutely. So Amy, back to you.
Yes. And today, just make sure that you're in the right class. We are bringing you Starting a Business in Arkansas. We have Lori Lieblong of the ASBTDC. Say hello, Lori. We have Cal Rose with Lindsey Jennings. Say hi, Cal. We also have Eileen Jennings, not related, with Arvest Bank. And this is a workshop format. So again, we are working to keep it as close to our in-person workshops as possible until we can actually get back in person. It's coming very soon. And while we're getting to know them, we would really like to get to know you. So please post in the chat with what industry you're looking to start a business in and any other details that you'd like for our presenters to know. This will help them tailor some of the conversation to you and to who we have here today. So Lori, I would love for you to get us started as our ASBTD consultant. Kick us off. We have some time to spend today together.
Okay, welcome everybody. We're so excited you're here. Again, I'm Lori. I'm with the ASBTDC. So we've got kind of a jam-packed agenda today. We're going to talk first about how to know if your business idea is feasible. Then we'll go through the workings of a business plan, talk about some other things that you need to think about when you're starting a business. Cal, who's an attorney, is going to talk about legal and tax issues. And then Eileen, who is with Arvest, is going to talk about financing your business. And then we will wrap up. So the first thing we'll talk about is how to know whether or not your business idea is feasible. We've all got a lot of cool ideas, but you need to really understand whether or not your business idea is something that can actually make money or be a financially viable business idea. You're going to think about all of these things concurrently. One of the things you'll think about is the market. I worked in the vitamin business before moving over to the ASBTDC, so I like to weave in some examples from that business into this presentation. So we know that in the United States today, people are starting to take a more proactive approach to their overall health. People are exercising more, people are eating healthier. So you're starting to see more all natural, 100% organic, preservative-free, gluten-free foods, for example. Gyms are popping up all over Northwest Arkansas. If you try to buy a bicycle during the pandemic, you know that there was a huge shortage in Northwest Arkansas. And so those are big drivers and drove demand for certain product categories in the overall health industry. So you also need to know your competitive forces. I worked for this national drugstore chain selling vitamins, and we saw through research that our customers found that those certain food attributes, the preservative-free, all-natural, 100% organic, were attractive in vitamins, and they were actually purchasing those types of vitamins in specialty retailers like GNC or Vitamin Shop or Vitamin World. And we knew that our key competitors like a Walmart or Sam's Club or Walgreens were not offering those types of supplements. So we felt like that was a great way to capture our market and get those people buying incremental vitamins in our store. Now, we had pretty advanced analytics to see our market size and potential market share, looking at that business. And at the ASBTDC, we also have some really awesome market research that you can have access to as part of our consulting services. If you're working with us to write a business plan or on financial projections or coming to us for marketing services, you can have access to some of our market research. And for example, say you want to start a market vitamin store in Northwest Arkansas, we can look at the number of people who have purchased vitamins in a 6-month window of time for any geography in Northwest Arkansas. If it's say 100 people and there are 3 vitamin stores, well, okay, maybe it's not a good idea to open a vitamin store. If it's 10,000 people and there's only 1 vitamin store, well, maybe there is a market for your vitamin store. And so we look at all those things and take those things into consideration to understand whether or not there's really a market for your product. So that's one thing to understand whether or not your business idea is feasible. Next, you need to look at management, both capacity and willingness. Are you able and are you willing to start your own business? And so you need to think about a lot of different things. Marketing, for one. You're responsible for developing a brand strategy, a marketing strategy, a marketing plan, a marketing budget, and then executing that. In companies where you have a large budget, that is a full-time job. If that doesn't sound fun to you, you're going to be responsible for outsourcing it. So we'll work on your finances and you'll be able to understand whether or not you can pay for that. And for most small organizations in the first year or two, you're going to have to do it yourself. So you really need to dig deep and ask yourself, are you willing to do this in the first couple of years of operations? You're also responsible for managing the finances. A lot of people cringe when they hear the word bookkeeping, and you're going to be responsible for that. And it's not just bookkeeping, it's making the decision in 6 months into starting the business or year 2, do you want to make that extra capital acquisition, buying that new piece of equipment, opening that second location? As the owner, you're the one making those decisions. Are you comfortable with that? Do you want to be the one to do the analysis to make those decisions? Then you're also making the decisions about operational efficiency and how to improve the business. I love to use the kale salad example. I like to make these really fancy kale salads and they're really expensive. I'm just waiting on some restaurant in Fayetteville to decide they want to do this as a business strategy so that I can go out and get my fancy kale salads. So say you're the Fayetteville restaurant that decides to do this and meet Lori Lieblong's needs for kale salads. And you've got this great regional distributor for kale. So you've got these awesome profit margins on kale salads. And so you're rocking and rolling with these kale salads. And then you find out from your head chef, you're actually having to toss half the kale because it's wilted. And so now you've got an issue on your hands. You're actually making half the profit margin you were. So now you've got to go figure out how to solve that problem. So you go to a local producer you're making less of a margin, but you've got a local producer, you've got more fresh kale. Well, then you realize you can make a claim that you're sourcing locally produced products. And so now you've got a marketing spend. So you end up net in a better space, but you're constantly thinking about that. Are you purchasing supplies from the best suppliers? Are you managing your employees properly? Are you operating as efficiently as you possibly can? But you're always the one thinking about that as the owner. There's no coasting per se when you own a business. You're also the HR manager and the people motivator. If you don't like to manage people, you're going to have to hire someone who does. That's a big piece of it. You're the people motivator, you're the hirer, the manager, the firer, all of that. There's an enormous human component in owning your own business. So the management piece is, do you want to, do you like to, can you, for all of these things? If you're not going to do it yourself, you're going to figure out in the financial piece whether or not you can afford to outsource it. And if you can't, can you grin and bear it until you can? So in addition, and like I said, you're going to be doing these all at the same time. When we work with clients, we're looking at this all kind of in conjunction with each other. But you also have to look at the finances. At the end of the day, if the business doesn't make money, there's really no sense in getting into it. We have a great tool that we use with our clients. It's a financial workbook that we sit down with all of our clients in. We start first at looking at startup costs. I tell all my clients, go find whatever you like to use to capture your startup costs, whether it's a big cheap tablet, an Excel workbook, or a PowerPoint presentation or Word document, and just make your list of all the one-time fixed expenses that you need to get your business started and put the costs down next to them. And then you're going to do the same thing with monthly expenses for 3 years. It's just like making a household budget. List your line items, go call, make the phone calls, get the estimates on the costs. Then we'll work together using market research to make some revenue projections based on your service or product offerings. You'll have a list of everything you offer to sell. And if it's products, you'll have a cost of goods or the cost of what you pay to buy those things. And then that's going to allow us to have projections for profit and loss statements or income statements and cash flow statements. And then it's also going to allow us to see how much money you need to start the business. You'll also contribute how much you intend to contribute to the business. And the difference is what you need to get from investors or borrow from a bank. That's going to give us a clear picture of what you need to start the business and what you need to borrow, and if the business is actually going to be profitable based on your projections. And so we might need to tinker with that a little bit and say, do you need to sell more? Can you cut expenses, et cetera, et cetera? But it's really critical to go through this process because you might have a great idea, but if it's not financially viable, it's not gonna deliver. So if you've gone through that process, the market, the management, and the money, and found, okay, yes, this is all doable for me. Yes, I want to do it. Yeah, it's going to make money. And yep, people in Northwest Arkansas want to buy my widget. It's time to develop a business plan. So there's 5 components of the business plan. You're going to have an executive summary, which you'll write last. You've got the products and services section, your market, the industry, operations and management, and the financial plan. The first section is products and services. So you'll explain what you're going to sell in this section. If you're a restaurant, it's not your menu. You'll explain that you're an Italian restaurant or a Mexican restaurant. You'll explain which meals you offer, whether it's breakfast, lunch, dinner, brunch. You'll describe if it's fine dining, family, casual, fast food, etc. If it's a location, you'll describe the ambiance of the location. You'll describe your pricing strategy and structure. I love to use the almond butter at Whole Foods as the example from pricing structure. The lever that you pull and put the almond butter in the container, that's bulk pricing. If you buy it in the jar, that's unit pricing. So you're going to explain your pricing structure and then your pricing strategy. Are you the premium offering? Are you the value offering? You'll explain that in the products and services. But you're going to go into pretty detailed information in this section, but it's not a menu or an item listing. The next section is your market. You're going to describe your target market. This is not a demographic explanation of an individual. You're going to describe your target market in great detail. For our vitamin consumer, this was a woman 25 to 35, high income, heavily involved in the vitamin category, buying at least 2 vitamins, exercising 5 or more times per week, into health and fitness, eating healthy foods. So we would describe this person in much more ways than her age and income. You're going to talk about your competition in detail. In what ways do you compete? How long have they been in business? We're going to talk about your brand strategy. What makes you different from your competition? What facts support that point of difference? Then you're going to develop your marketing strategy and list the tactics that you intend to employ to compete with your competition. All of this is going to be supported with market research. And like I mentioned, we've got some really valuable market research that we can help provide you with to make these decisions and come up with these recommendations. The next section is the industry. Again, we've got some really great research that you can use for this section. You're going to use the industry section to educate and inform your readers. And then for you, if you're getting into a new industry, this is going to help you better understand the industry itself. You'll address sales and marketing in the vitamin business. We did a lot of price promotion, co-promotion with products that we're selling well with our products. In the example of the specialty vitamins, we did a lot of co-promotion with health and beauty products. We also did a lot of in-store advertising and advertorials in magazines. You're going to address finance and regulation. The vitamin business is not regulated by the FDA, but it's heavily scrutinized by the FDA. So you have to be really careful with your marketing. Also works in the tobacco industry. Taxation in that industry varies from state to state, so it has a high impact on your pricing strategy. You're also going to address the elephant in the room. I'm working with a lot of businesses right now that will be affected by COVID that are trying to get started. And so you have to address that in a business plan. What is your game plan to mitigate the COVID impact? So whatever that business challenge or elephant in the room is, you're going to address in the business plan. And then what are the opportunities? What are the niche? So for us, the major niche and the major opportunity was getting into those food trends that were attractive in the vitamin business. The next section is operations. I like to call this people and processes. You're going to talk about the owners and key players in the business, what their job functions will be, what their backgrounds are. Then you'll describe the job duties of anyone else you intend to hire. And then you're going to explain the day-to-day operations of the business for a full cycle of operations. So if you're a restaurant, you're going to describe your business open to close, and then address inventory turnover, like what's your ordering plan, what's your sell through for supply of foods, etc. Then you'll describe how you intend to handle marketing and accounting, so that when the reader reads through this, they feel confident that you have a plan for how you intend to operate the business. Finally, you'll propose your budget and financial plan. Now, you're going to have our financial workbook as a backup, but you're going to explain how much money you need, what your financial projections are. So your gross sales for 3 years, your net profit for 3 years, what your financial request is, what you're putting forth as your down payment for a loan or your contribution to the business. You'll include all of that in your financial section, and then you'll explain that you have detailed financial documents amended in the business plan. So the executive summary, you're going to write this last, and this is to highlight all of the topics that you're going to hit in the business plan. It should be 1 to 2 pages, and the purpose of the executive summary is to give the reader an understanding of what they will find in your business plan and engage them so that they want to read the rest of the business plan. It's supposed to be high level. You'll talk about, give a brief description of the company, talk about your target market, your plan for marketing, a little bit about your competition, your marketing, your financing proposal, and get all of that information together in a concise manner so someone can quickly understand what the business is and what your plans are, and be able to make a decision about whether or not they want to read further about the business plan. And again, you write this last after you've gone through the entire business writing process. Finally, there are a few other things that you need to consider when starting a business that a lot of people might kind of forget about. I like to use my colleague. I worked with a marketing consultant in New York who had the equivalent of like marketing malpractice insurance. And like, who would ever think of that? But she made a $250,000 mistake on a business that she was working with, and she had some kind of marketing malpractice insurance that covered this $250,000 mistake that she made, and paid the company she was working for this mistake that she made. And so it just goes to show what kind of insurance you might need that you wouldn't otherwise need. And so the conversation is going to go, you need to go to a small business insurance agent. They're going to ask you a lot of questions, and they will help you determine what kind of coverages you need. Some basic types of coverage you might need would be property and casualty to cover your properties, general liability, product liability if you're selling a product, this covers you in case a product injures someone, workers' comp, so that if your employees get injured, you can cover that, business interruption if you have to close for some reason, this can cover lost sales, and then keep person insurance or life insurance in case someone critical to the business passes away. You also do not want to have human resources issues on your hands. So you want to understand the employment laws. Check with the Arkansas Department of Labor. You need to understand the differences between an employee and an independent contractor. Do you have the choice of hiring employees and hiring contractors? It's a different relationship. Employees work for your company. You pay them benefits. They're W-2. They're taxed differently. You pay taxes on employees. Independent contractors do not work for you permanently. You don't pay taxes on them. They're easier to hire and fire. You need to know the proper practices for interviewing and hiring. You want to make sure you don't make any mistakes there. Again, human resources issues can be problematic. You can go to the Rogers Lowell Chamber, I believe, and find a template for a personnel manual or an employee handbook. It's a really great idea to do that. You have some good guidelines, and parameters for employees, and then it makes it much easier to reprimand or give feedback to employees. It makes dismissal much easier if you've got a roadmap and a framework in place for employees. You also might consider employment or temp agencies to help you with the recruiting and hiring process. That can be a really effective way to recruit talent. There's also things to consider with home-based business. I get a lot of people call me and maybe they're thinking about starting a business or they've already got a little home-based business going. And the first thing I ask is, have you checked to see if you can do business out of your home? I have one client this week and they hadn't, and they've been doing business out of their house for a year. I'm like, okay, you need to check on that. Because you don't want to be cooking along. You've been doing business for a year and then find out from your property owners association that you can't. And then you've got to shut down or quickly find a location. And that can be problematic. So you need to check whether it's your POA, the Planning Commission for zoning laws, and make sure that you can do business out of your home. There are tax advantages for the business use of home. You talk to a CPA about this, but you can expense a portion of your rent or mortgage and utilities because you do have a home-based business. You need to make sure when you're talking to that small business insurance agent or your home insurance that you do get the proper insurance coverage if you're doing a home-based business. You also want to think about your mailing address and your phone number for your business if you're doing it from your home. I personally would not want people knowing my home address or having my personal phone number for all of my customers, especially if you think like e-commerce business. So you want to take that into account. For some people, it may not matter or be problematic, but you want to consider that when you're making those decisions. And then finally, marketing your business. I know, when people are putting together those financial workbooks and we're thinking about borrowing money and there's that line for opening marketing plan, people think, let's keep that small. I don't want to make that a big, let's keep that to $1,000. Let's not build that big. It is really critically important to invest in your business. First things first, really develop a strong strategic brand strategy and marketing strategy. It's so important to lay the foundation for your business and think about it strategically and really think about your brand and your marketing strategy. Build a marketing plan, have a budget, have that laid out in advance before you walk out. It's not a matter of pushing a button on Facebook. Put some forethought into it, build a budget, invest in marketing your business. At a minimum, you have to have a website to look like a legitimate business. Choose your social media platforms wisely. If you're marketing to teenagers, TikTok is probably where you need to be, or Snapchat. If you're marketing to my 70-year-old dad, he is on Facebook nonstop. If you are in a service business, if you're selling yourself, don't underestimate the power of networking. Still get out to chambers of commerce and then local networking groups. There's a website called nwanetworking.com that lists most of the networking groups here in Northwest Arkansas. I send a lot of clients to that. I still get out and network with this job after I've been doing it 5 years, and I still take time throughout the year to hit the networking groups to just meet people and share about our services. So it's just really critical to invest in your business and do the work on marketing. And I will now turn it over to Cal so that he can talk to you about legal and tax issues.
Thanks, Lori. I was just going to let everybody know we've had some great information, some businesses that have popped in and said what kind of businesses they're thinking of. We'd also love to know kind of where you are in your process. If you're at the very beginning, if you've done some of this work, or if you're already going and blowing and maybe having to go back and do some of this. But we have everyone from a consultant to a real estate investment firm, mental health counseling, a bookstore, R&D for green tech, which is fantastic. We also have this is my favorite, my new favorite, a hen rental business. So renting a hen so people that live in town can have fresh eggs. It's amazing. And also a virtual assistant and social media management. You all continue to please go ahead and post those in there or let us know kind of where you are in your journey. It really does help everyone to kind of know what those are. And oh, and Eileen's asking her own question, which is what makes you most nervous about starting your own business? That's a great question. We also had somebody ask if you would get a copy of this presentation, and yes, you will. You will get this to your email inbox. We have your names, and when we're taking attendance, so we'll let our team know to send that to you because it is a ton of information. And last but not least, continue to post your questions if you have any. We're going to kind of run through the gamut of all of this information, but we will have some time at the end to take your very specific questions. So you don't have to hold on to those. You can go ahead and put them in there as we go along, or you can ask them yourselves as we get to the end. So hi, Cal. How's it going?
I'm good. How are you?
Good. We're excited to hear from you today.
You don't usually get excited listening to a tax attorney, but hopefully today I won't bore everybody too much.
Yesterday, people were not excited to hear from you.
No, they were not. They were very adamant about hearing from me, but they were not excited.
Exactly.
Before I get started, is my screen share, is that looking right to you guys? Okay. Well, I appreciate it. And Lori, thanks for kicking off the presentation. My name is Cal Rose. I'm a business and corporate and tax attorney based out of Rogers. Our law firm, Wright, Lindsey & Jennings, has been around for over 100 years. Our main office is based out of Little Rock, and we have a satellite office up here in Rogers where we do all of our Northwest Arkansas work. And we handle all different types of legal issues, but what we're going to talk about today is legal issues that are specific to starting a new business, and some potential tax issues, some contractual issues that you may run into as you're starting a new business. And so that's what we will focus on today. I always like to start off with this slide because everybody always has a great idea. It's always like, hey, I have the best idea in the world. I'm going to invent Post-it notes. But you actually have to follow through and actually invent Post-it notes. You can't just think of it first. And so it's a good way to just kind of like kick off. We certainly understand the challenges that small business owners, especially if this is your first time going through the process, encounter, and people like me and Lori and Eileen can hopefully help navigate through those issues and make it as seamless as possible. Here's a little roadmap of what we're going to be kind of covering in my part of the presentation today. The majority of it will be going over the differences between LLCs and corporations and different entity structures. We will touch on some tax and regulatory issues, as well as some common employment issues, employment handbook issues, and contracts that most small businesses will see, although things like leases are not nearly as common as more and more businesses are able to kind of work remotely and work in that home business structure that Lori was discussing. So why should you care about all this? The biggest one that we're starting with is limiting your liability and protection of your personal assets. We'll talk about this here in a little bit, but the default rule, if you don't take a step to form an LLC or corporation or some other type of appropriate entity, is that when you start a business, you're in that business in your own individual personal name. And so if your business is sued, well, you personally are being sued, and your personal assets are subject to creditors, lawsuits, and all of those things. And so, most of what I do in helping small businesses and entrepreneurs get up and off the ground is putting that entity structure in place that provides for the protection of your personal assets and limits your liability solely to the assets of the company. Ease administration, tax benefits, avoiding litigation. Don't tell anyone else in my firm, but my job is to make sure that you don't sue people and don't get sued. My job as a corporate and business attorney is to keep you out of the courtroom, to try to, on the front end, put structures and processes in place that can kind of help you avoid that worst case scenario. Transferability of ownership. That conversation is always around, if you're 50-50 owners with someone and that person no longer wants to be in the business, or God forbid something happens to them, how do you handle bringing new owners in, bringing family members of old owners into the business, managing cash flows and protecting your intellectual property. Those are not as important necessarily in terms of operationally at the very beginning, but as your business starts to pick up speed, managing your cash flows can help you go to someone like Eileen and seek capital and loans and credit that you need. And then obviously protecting your intellectual property. If you have anything that is unique, proprietary to your business, you want to make sure that you're taking the appropriate steps to protect that and to prevent others from using your intellectual property. Structuring your business is probably where we're going to spend the bulk of our time today. And there's kind of 4 general categories that I've broken this down into. You have sole proprietorship and a partnership. Those are kind of lumped together. If you take anything away from my presentation today, it's that you don't want to be a sole proprietorship or a partnership. You want to be one of these 2 categories down here below, which are corporations. There are differences between S corporations and C corporations. Those are tax differences. They are not legal differences in the sense that your legal liability isn't treated any differently or anything like that. It's really just a tax distinction. And finally, the most recent and really the most common and prevalent entity that we see today is the limited liability company. That's probably what most startups and most of you who are starting a business will be. You will be a limited liability company. A lot of this has kind of been thrown on its head recently because the state legislature is passing an entirely new Limited Liability Company Act. So all of the provisions that we're currently have in place are going to be amended and replaced with a different act. We'll talk a little bit about that, but for the most part, that goes beyond the scope of this presentation.
Cal, just real quick, would you mind touching just lightly on B Corp? And then if we have more in-depth questions about that later, we can go into that.
Sure, absolutely. So what Amy asked about was a B Corp. It's often called a benefit corporation. These are very new, and they are kind of a blend hybrid between a traditional corporation and a nonprofit. B Corps have some sort of public benefit, some sort of public good that is part of their charter, that is part of their purpose. And the reason legally why it's important to distinguish between a B Corp and a traditional corporation is before B Corps existed, we kind of had 2 regimes. You had for-profit entities, for-profit corporations, and then you had nonprofits. Nonprofit corporations essentially can't have owners, and they can't. While many nonprofits make a lot of money and might be profitable, there's no such thing as like an owner distribution or a dividend in a nonprofit. All of the proceeds in a nonprofit have to be used for that charitable purpose. Okay, contrast that with a C Corp or an S Corp, a traditional corporation. We have laws on the books. The way those corporate statutes are written, the way court cases are handed down, is that your role as an officer or a director or someone who's running and operating that company, your role is to maximize profits for the owners. I mean, that is the #1 kind of guiding principle, is that you are supposed to run the business in a way that maximizes the profitability of the company. 5-10 years ago, you started having a lot of these companies like Tom Shoes. We have them here locally, Tacos for Life. A lot of these for-profit companies had an altruistic kind of slant to it. Some of it was marketing, but a lot of it was truly a kind of charitable purpose. And our statutes didn't have a very good way of handling that, because you were either a nonprofit and you couldn't have owners, you couldn't have dividends or distributions, or you were a for-profit. And if you were a for-profit, well, there were lawsuits and arguments made by shareholders that giving away a pair of shoes every time you sell a pair of shoes is not the best way to maximize profitability. Giving away a taco every time we sell a taco does not coincide with the requirement that for-profit entities have to be run strictly in a manner that maximizes profit. B Corps or benefit corps kind of were created very recently to kind of bridge the gap between the 2. And so basically what a B Corp says is you are a for-profit entity. You're not bound by all of the nonprofit extra requirements that a lot of nonprofits are required to have. You can have owners, and one of your purposes can be charitable. One of your purposes can be donating goods or services to people in need. And B Corps are basically structured in a way that says, as an officer, a director, someone running that business, that you will not get in trouble, you will not violate the corporate statutes because that is part of your purpose. And so that's really what a B Corp is. We're seeing a lot more of those now than we certainly used to, because they're pretty new. But it's essentially kind of like a hybrid between a traditional for-profit entity and a nonprofit. Okay, so we will move on to sole proprietorships. As I mentioned earlier, my hope from what you take away from this is that you are not a sole proprietorship. And this is kind of the default standard. If you go out and engage in a business activity, like little Timmy here, he's setting up his lemonade stand, he's doing it for a profit, he's doing it for a business. He is a sole proprietor. If he has no other owners, it's just him. He handles all the expenses and all of the revenues. He is in what we call legally a sole proprietorship. The good news, or I guess the advantages of a sole proprietorship, is there's one, you don't have to go to attorney or LegalZoom or anyone else to set up an entity, and you don't have to pay any fees or anything like that. The downside, which is a big one, is that you have no liability protection. Little Timmy here inadvertently mixes together a bad batch of lemonade, and a lot of people get sick and they sue him. They can sue him and take his bicycle, his baseball card collection, his lemonade stand, and everything else that he owns. There are some protections. If Timmy owned a house, the law does say that you can't physically take their house, although you can take their equity in the home. And so the takeaway here is that if you don't form an LLC or a corporation, and you have one owner, you default to what's called a sole proprietorship, and that means you have unlimited liability for the debts, the obligations, lawsuits, anything like that that could go wrong. Briefly, we'll talk about a general partnership. It is the exact same concept, except it's not one owner, it's two owners, two or more. So you could have 3 or 4 owners in a general partnership. Same concept applies. You are personally liable for the debts and liabilities. Where it gets even more disadvantaged in a general partnership is not only are you liable for the debts and obligations of the business, you're also liable for the actions of all of your other partners. One of your partners goes out and, outside this lemonade stand, does something to cause a bicycle wreck, hurt some people, and you had nothing to do with it. If your business partner does that in connection with business activity, you become personally liable for their actions as well. So again, general partnership, sole proprietorship, that's the default. It's easy because you don't have to do anything, but the big downside is that you have no liability protection and you're responsible for the actions of the other owners in the business. So this is where attorneys come in. This is where online services that you can use, such as LegalZoom, can come in to kind of help bridge that gap, do away with that unlimited liability. And the first type of entity we'll talk about is the C corporation, because it's the oldest. It's the traditional business entity that a lot of entrepreneurs and traditional businesses have used in the past. A C corporation is a separate legal entity. It is separate and distinct from its owners. If we look at First Amendment law, corporations are considered people for purposes of First Amendment giving. And so it is a complete and separate entity from the owners. You form a corporation by filing what's called the Articles of Incorporation with the Secretary of State. And then internally, you have a document that are called bylaws that kind of give you guidance on shareholders meetings, directors meetings, how to approve certain things, how to run the business. Corporations have, I always kind of think about it, it's down there on separation of powers. Corporations kind of have 3 branches of government is the way that I kind of look at it. You have shareholders, the people who own the financial interest in the company, or similar to the citizens of our state who vote for the board of directors. The only power or right to participate in the business as a shareholder is to elect your board of directors. A board of directors can have one director. It can have 3, it can have 11, it can have 21. There's no limit. I don't recommend having that many, but you only have to have one board. And so for a lot of you that are starting a business and you're the only owner, it's not uncommon at all for you to be the 100% shareholder, and then you elect yourself to the board of directors. And then now you're the sole director. The role of the directors are then to appoint officers, a president, a secretary, a treasurer, CEO, things like that. Those officers then run the day-to-day business of the company. So, if you think about publicly traded companies, obviously you have thousands of shareholders who vote once a year on the board of directors. Those directors meet once a quarter in order to review the kind of high-level operations and financials of the business, and then they appoint the president, vice president, things like that. For small businesses, it's usually the same person is the shareholder, is the officer, is the director, and that's completely fine. You still, though, with corporations, have to go through the formalities of having a shareholder meeting every year to appoint directors, having a director meeting every year to appoint officers, and keeping those roles separate. The biggest downside to a C corporation is the double taxation. You may have heard somebody talk in the past about the double taxation of C corps. We talked about C corps are legally distinct from the owners. They are its own entity. It's their own person. They are its own taxpayer. And so however many profits the C corporation at the end of the year has generated, they pay taxes on that. That tax rate used to be 35% a couple of years ago, and down to 21%. Current talks are about bringing that back up. I've seen Biden's plan being 25 or 28%. Who knows what will happen? But today, as it stands today, the corporate tax rate for C corporations is 21%. Where that double taxation comes in is the corporation has to pay that tax before they distribute money to the owners. And so if you're a shareholder and the business makes $100,000 of profits and you want that $100,000 for your personal use, well, first the $100,000 gets taxed at the corporate level, 21%. Now you have $79,000 left. Then the corporation has to make a distribution to you as the owner. You pay a tax on that. It is currently the capital gains rate, which is either 0, 15, or 20%, depending on what bracket you're in. But let's just say it's 15% for most people. You're paying another 15% on whatever's left over, that's 79,000, which leaves maybe 65,000. I'm doing math off the top of my head left, but you see it gets taxed twice before it gets in the hands of the owner. That's the biggest drawback of a C corporation, and it's why most CPAs, accountants, advisors will tell you not to be a C corp because it gets taxed twice, unlike S corps and LLCs, which we'll talk about. S corps, again, same legally, it's the same type of entity as a C corp that we just talked about. The only difference is that tax purposes, the taxation of S corps are handled differently. It is much more similar to partnership taxation. You'll oftentimes hear this referred to as pass-through taxation or flow-through taxation, because unlike a C corp, an S corporation does not pay taxes. An S corporation has a tax return where it calculates how much taxes or how much profits were generated from that business. But essentially what happens there is those profits are passed through to the individual owners, and the individual owners pay taxes based on the income. And so use the same example, an S corp this time, at the end of the year, it made $100,000. Well, if you're the owner of that S corp, on your personal income tax return, you're going to get a K1 that is going to say you made $100,000 of profits and you owe taxes at your personal income tax rate. So it's taxed a lot more similarly to wages, salary would be, because it's just based on your personal situation. There are some tax benefits to S corps. Traditionally, for that reason, because it's not taxed twice, most CPAs or accountants would recommend that you be an S corp or a partnership, which we'll talk about on the next slide. There are a few things that CPAs and accountants don't always tell you about being an S corp. is that the benefits, the tax benefits of an S Corp come with a little bit of a price. The IRS has enacted some requirements that you have to meet in order to be an S Corp. And if you don't meet those requirements, you default automatically to a C Corp. The biggest of those is all owners of an S Corp, all shareholders must be individuals, must be US citizens. So you can't have an LLC or another corporation own any shares of an S Corp. That becomes really relevant if you are a business that's going to go out and try to raise money from angel investors, VC investors. If you're going to try to go out and raise money that way, being an S Corp is a bad idea. It does not really work very well because most investors in that kind of professional space are going to invest through an LLC or an LP, some sort of entity that protects their investment, and they can't do that in an S Corp. And so CPAs don't always tell you that. If you're the type of business that thinks that you might want to take on investors in the future, you should be a LLC partnership or a C Corp, not an S Corporation. Another part of that is you can only have one class of stock. You will see, again, with companies that go out and take investment or a little bit more sophisticated structures, you'll have common stock, you'll have preferred stock, you might have multiple classes of different types of stock. You can't do that in an S Corp. Everybody has to own one type of shares. It's the traditional, if you have one share, you have one vote, and you have equal say in distributions and the profits of the company.
Hey, Cal, I've got a quick question, and this is very, very common, but what happens if one of us open up and we are a sole proprietor? How easy and what do we do to switch over to maybe an LLC or an S Corp or a C Corp? How does that all happen?
Yep. So there's no, I mean, essentially you would just form one of these entities. There's really not a transition, so to speak. I mean, it's as simple as filing the paperwork with the Secretary of State needed to create the S Corp, create the LLC, create the C Corp. You know, there are some things like if you developed intellectual property or if you signed contracts in your sole proprietorship name, and a lot of times that's, you know, just your individual name or a DBA. If you form a company, you would transfer those existing things into the name of the new company. That's really the only kind of transition, but you know, for the most part, it's as simple as just forming an LLC, forming a corporation by filing the necessary paperwork with the Secretary of State, and then, you know, just running the business under the name of that entity instead of, you know, your individual name or some DBA that you've filed previously. Okay. From there, we will kind of move on to limited liability companies, LLCs. It is, again, we talked about earlier, probably the most common. It's generally speaking, the easiest to set up, the easiest to operate. It's a little bit cheaper than a corporation in terms of hiring an attorney to set this type of entity up because there's a lot fewer formalities. You don't have that mandatory separation of owners, board of directors, officers. You don't have to have a shareholders meeting every year. You don't have to have a board meeting every year. It's a lot easier in terms of what the statutes require. In an LLC, you know, in a lot of ways you can set it up, and as long as it's set up properly, you don't have to have formal meetings or get together once a year or do any of that stuff. Like once it's set up and ready to go, it's set up and ready to go. You still have to operate it in compliance with the law, but you don't have these mandatory meetings that you see in corporations. You know, just from a kind of nomenclature standpoint, owners are not shareholders in an LLC. They're called members. And usually the people who run the business are called managers, managing members, something along those lines. LLCs from a tax perspective are just kind of strange, frankly, because our tax code that we use today that applies to all business entities, to individuals, was created in 1986. LLCs did not exist in 1986, at least not in Arkansas, not in most places. Arkansas's LLC Act was created in 1993. And so because of that, our tax code does not use the term limited liability company. There is no framework for how LLCs are taxed, because they didn't exist. So what our tax code has done is they've kind of adjusted to say, all right, if you're an LLC, you can essentially choose which way you want to be taxed. You're still an LLC for legal purposes, but if you want to, you can be a partnership. If you wanted to, you can choose to be a C corporation. You can choose to be an S corporation. If you choose to be an S corporation, even though you're an LLC, you still have to comply with those laws we talked about previously about, only having U.S. individuals as owners, only having one class of stock. So those things would still apply because those are tax code laws. But legally, you would be an LLC, but for tax purposes, you would be essentially anything that you want. There is a form called it's called the check the box form, literally because it says corporation, S corp, partnership, something else. Check whatever box you want to be for tax purposes and send it to the IRS. And that is going to be binding and controlling moving forward. Limited liability, we've talked about it. It's the biggest benefit of LLCs and corporations. It's the biggest reason why people come to attorneys in the first place to start a business is because they don't want their personal assets to be subject to creditors. This limited liability protection is not just like without exception. You are still personally liable for fraud. You're still personally liable for intentional misconduct. Gross negligence, at times you can be held personally responsible for that. Criminal activity, you're still personally liable for that. So this limited liability shield is not absolute. There are exceptions. You still have to, kind of run your operations in a diligent way. As long as you do, and as long as you don't, do some other things that we'll talk about here in a second under piercing the corporate veil method, then your personal assets should be shielded from creditors, and you won't have to worry about being personally liable for any of the debts of the company. There are exceptions to this, which Eileen may address in her part of the presentation. There are things called personal guarantees. You see in almost every loan document. You see it in leases. You see it in a lot of just very complex commercial contracts where if you go and apply for a loan from a bank in the name of the business, most of the time, if not always, they're going to require the owners to personally guarantee that loan. When you sign a personal guarantee, all of this limited liability that we're talking about, that goes away as to whatever you personally guaranteed. And so in the loan, obviously, if the business defaults or goes bankrupt or something like that, if you sign the personal guarantee, you're still personally liable for it. Same thing with lease agreements. A lot of times those have personal guarantees. Another way that your limited liability can be kind of taken away is what's called piercing the corporate veil. Sounds cool. It is not. It is a doctrine that courts use to essentially say one of two things. If you don't comply with the LLC Act or the Corporate Act, then we're not going to give you the benefits of it. Essentially, what courts have said is, in order for you to get the benefits of limited liability, you have to comply with all of the statutes that are applicable to your business. And so, basic example, if you're a corporation and you don't have board meetings and shareholders meetings, and you never elect officers and directors, and you don't pay your franchise taxes, if you don't do all of those things that corporations or limited liability companies are required to do, then a court can say, well, you're now personally liable because you didn't follow through with your end of the bargain. Another piercing the corporate veil strategy or doctrine is basically whenever you are using the business as really just an agent of the individuals behind it. So the biggest thing here is commingling assets. If you are using the LLC's funds or the corporation's funds to pay for your personal vacation, to buy personal four-wheelers that you just wanted to use on your farm, if you're paying personal bills with the company's money, a court will say, well, look, you didn't treat this limited liability or this corporation separately from the owners. Since you didn't treat it as a separate entity from the owners, then we're not going to treat it as a separate entity either. And so, it's not as simple as just going to LegalZoom and now you've set up an LLC and you're off to the races and you have absolutely, no risk whatsoever. You still have to run the business the right way. You still have to treat the business as a separate entity with separate bank accounts, separate financials, separate expenses than what you are doing in your own personal individual capacity. This is just we won't spend too much time going through this. This is mainly just so for you to have in your slides. As you can see there, corporations, the way you form a corporation is filing articles of incorporation. LLC, they're called articles of organization. And just there's some of the differences, in the documents that each has and some of the nomenclature used for those types of entities. So a big one to always think about, before you go and file that LLC, or before you go and just kind of run headfirst into a business, there's a few things that you definitely need to be looking out for. Lori touched on those in her presentation around marketing. The first thing you need to do is do a name availability search. Don't think that you're going to be, start a new restaurant and call it McDonald's, right? I mean, it's not going to work. You would be surprised at how many names exist for all different types of industries throughout the country, not only locally, but all over the U.S. That's essentially what you have to worry about, and do some diligence on the front end. Make sure whatever name you're going to use, logos, trademarks, if you're going to be using those things as part of your advertising, you need to do some diligence on the front end to make sure that that's not infringing on anybody else's name, that it's not too similar to other businesses that are using the same logos or names in a similar industry. You can figure out a lot of that by doing a Google search. You can go to the trademark office and do just a simple search, and they will tell you the names that have been trademarked and what industry they are in. The last thing you want to do is spend a lot of time, money in marketing, creating business cards, a website, all of these other things. And then as soon as you get profitable, or as soon as your business starts to grow, you get a cease and desist letter from someone in Indiana saying, we already have a restaurant or a business in your industry with this name, and it's confusing our customers that you are using the same name or a similar name in a similar industry, so you have to stop using it. It's certainly possible. It actually happens quite often. And so before you kind of move forward too much, especially with any sort of heavy expenditures around branding or marketing, you should make sure that that name, that marketing logo is available. Speaking with an attorney and a CPA, I'm biased. I think you should. I definitely recommend getting a good CPA. I think a good business CPA who works with small businesses and is used to the kind of deductions and taxation that small businesses and entrepreneurs encounter, those CPAs will save you more money than what they charge in fees. And so I always encourage people sooner rather than later to engage a CPA and start building that relationship. You may not need all of the services that they offer in the beginning, but if they're familiar with your business, as you grow, you can grow that relationship with them. Key questions for founders. This is kind of more in the doing your diligence and thinking through some common issues that happen on the front end, rather than waiting until they become a problem. A lot of issues are handled much better with owners, with partners in your business, if you can figure out a way to handle those situations in the beginning. And that's a lot of what attorneys and advisors will kind of help you think through. For instance, a common one, especially we see this all the time in 50-50 businesses. If you go into a business and you're 50-50 owners with another person, I'll just tell you, there is no good way to resolve a dispute in a 50-50 in a 50-50 ownership company. There is the way that the law resolves that dispute is if y'all can't figure it out, we're just going to shut down this business. That's not always the best way over the long term to sustain value, to keep growing the company. It's essentially kind of like the King Solomon approach of we're going to cut it in half, and we're going to give you one half, and we're going to give the other owner the other half. It didn't work in the Bible. It doesn't really work that well in practice as well. And so one thing that you can do is put a plan in place for how those disputes are handled, whether it's through arbitration or some sort of buyout provision. How much time is each person going to commit to the business? You see this happen all the time where businesses start up and, whether it's 50-50 or some other ownership, you may have somebody who says, well, I'm going to give you 20% of the business, and you're going to develop a website and run all of our intellectual property. You do the documents, you give them 20%, and then they never give you the website. They never follow through on their end. Unless you have provisions in your operating agreement or in some sort of contract, once you give someone shares or ownership in your business, there's no requirement that they give them back. So you really need to make sure if there's any sort of like service for equity type of arrangement that's documented, it needs to be documented on the front end. Again, you don't want to have to wait until afterwards till one of these issues arises before you start to address it. Then how can founders or owners be removed from the business? How are decisions made? How, what happens if you want to sell the business, or if, two of the owners want to sell a business, but the third doesn't? All of these types of questions, if you don't build it into your operating agreement, your bylaws on the front end are just extremely difficult to address later on. And I always encourage founders and new entrepreneurs to try to think through all of those types of issues and address them up front. A quick plug on some resources in terms of regulatory and licensing. You're going to need a city business license in most places where you operate your business. Zoning laws, Lori talked a little bit about it. A lot of residential areas are not zoned for commercial purposes. You might have POAs that prevent you, but you also have city zoning laws that say this area has to be used strictly for residential, and there can be no commercial activity. And if you don't want to build a business out of your house only for it to be shut down, ASBTDC offers some really good tax information and resources. I put a link to that here. Obviously, if you are a bar, a restaurant that wants to serve alcohol, or medical marijuana company is probably the easiest to think of. There are licenses for those specific types of businesses that you have to go out and obtain before you can operate. Department of Finance Administration of Little Rock will help you through the process of getting a sales tax number and setting up your sales tax withholdings and deposits through their office. Taxes, briefly, we'll talk about this. There are a lot of taxes. That's probably the number one thing you hear from small business owners is that, it's not just income taxes. There are self-employment taxes. When you are an employee of a business and you get your wage statement at the end of the week or month, however you're paid, there's all of the withholdings at the bottom of your wage statement for FICA and Medicare and Social Security and all of those types of things. When you're an employee, the business pays half of those taxes, and half of those taxes come out of your paycheck. When you are self-employed and you are working for yourself, in the eyes of the government, you are considered both the employee and the employer. And so this can take people off guard. Those taxes are 7.2% for the most part, 7.4% for the employer and the employee. When you're self-employed, in addition to your income tax, in addition to the sales tax that you have to charge and collect, you have to pay an additional 15% on the profits that you are essentially entitled to, which can be a big surprise and a big pain for a lot of new small business owners who weren't thinking through that. So again, this is one of the benefits of having a good CPA or a good accountant who can kind of help you plan for what your tax situation is going to be. This can take people off guard at the end of the year whenever they get a tax bill for an extra $50,000 that they weren't contemplating and that they don't necessarily even have because they've spent it on buying inventory or equipment or things like that. So again, we won't go into every single detail of those, but having a relationship with a good CPA, tax attorney, accountant can kind of help you avoid running into huge issues with those. Franchise taxes, I'll plug those real quick. When you form an LLC or a corporation in Arkansas, the Secretary of State charges you a fee to maintain your status as an active entity. That fee is called, they're called franchise taxes. It's $150 a year. You have to pay them every year. If you don't, you are not in compliance with the statutes. That limited liability that we talked about earlier can go away. Secretary of State will not be very nice to you, and your company eventually can be taken away if you don't pay that $150 each year. Again, this is kind of just for your slides, some tax resources that you can review to expand a little bit more into some of these issues. Briefly, we'll just hit on a few employment-related issues that we see with small businesses. You know, a big one is independent contractor versus employee. When you start hiring people for your business, employees, when you have employees, are governed by your own workers' comp. If you have benefits, your employees have to be covered by those. We talked about that self-employment tax where, you know, with employees, the business pays 7.4% of those self-employment tax, and the employee pays the other 7.4%. So if you hire someone as an employee, you have to withhold and pay your part of those self-employment taxes. Independent contractors are not employees, so they're not covered by your workers' comp. You don't have to withhold anything. They're solely responsible for their own taxes. That, for a lot of people, a lot of business owners, is very beneficial, and they want to classify everyone as an independent contractor versus an employee. But the IRS has cut onto this too, because what happens a lot of times is independent contractors don't know that they haven't been paying taxes. They just assumed that the business withheld taxes. And then they get surprised at the end of the year that they owe a lot of taxes to the IRS, and the IRS doesn't get paid. So this is something the IRS is really cracking down on. To be an independent contractor, that employee or that service provider, I shouldn't use employee there, that service provider needs to control their own hours. They need to control the way in which they perform job functions. I mean, they are essentially like a contractor on a construction job that, you know, you might give them 2 weeks to complete it, but they control the manner in which they do it. They're kind of independent of your direction and control, although you can certainly give them guidelines. Those are the things that the IRS looks at. So if you have somebody that you're qualifying or characterizing as an independent contractor, but they work for you Monday through Friday, 40 hours a week, or even if they work 30 hours a week on a pretty set schedule, and you control when and they come in and out and how they go about doing their job, it's very likely that they are legally an employee, not an independent contractor, which means legally you would have needed to withhold taxes from their paycheck. And if you haven't, you're subject to IRS penalties, fines, and back taxes that would be owed. So that's just to say independent contractors are easier and a lot of times better for small businesses, but there are some downsides, or at least some compromises that have to be made if you want to qualify somebody as an independent contractor. Every small business, especially as you start to grow, should have an employee handbook that goes over things like harassment, discrimination, drug testing. If you drug test in your business, your policies need to be in a written employee handbook, incident reports, and clarification on at-will employment. A big one is medical marijuana in the workplace. There are very strict penalties if you discriminate against medical marijuana users under Arkansas law. You can be fined and held financially very responsible for firing someone who is a medical marijuana card holder. You can still take discriminatory or employment action against them if you have reason to believe that they were using during work hours while they were on the job. But where this comes into play most often is that a medical marijuana user can be using at home outside of office hours, work hours, and not affect their employment or their services whatsoever, but they would still test positive on a drug test. And so the takeaway is that you can no longer rely simply on a failed drug test to fire someone if they have a medical marijuana card. There are some exceptions if you operate heavy machinery, if you're a doctor or in surgery, or if you could injure or kill someone in the scope of your employment. But those exceptions have to be set forth in your employment handbook. Employment agreements are another big one that you need to have, especially with anything around intellectual property. If you are the type of business that does research and development and that creates a new product, you want to make sure, especially if you have independent contractors who are helping you develop, commercialize, create whatever that product is, you need agreements with them saying that the company owns the intellectual property and not them. Again, independent contractors are their own business. If they create a patent or a product that can be patented, they have a claim that they own it and not you as the business, even if you paid them for those services. And so anytime that's an issue, you want to make sure that you have appropriate documentation in place to protect intellectual property, non-disclosure, confidentiality. You also want to make sure that your employees and independent contractors, service providers aren't going out and talking about your business or anything that you consider secret or confidential or proprietary. We'll go through these very quickly. Small business contracts, typical ones that we see. Leases. Leases are the biggest one. We see less of these as businesses start migrating more to online or operating out of your home. Just know that leases, especially in Northwest Arkansas, if you go to any of these office parks, they're going to have sometimes 20, 30, 40-page lease agreements that you're not going to want to read, you're not going to pay anybody else to read, and you're going to sign it. That happens all the time, and it is not recommended. Lease agreements in Arkansas, if you sign a 5-year lease, you're personally on the hook. Your business is on the hook for that 5 years, even if you leave after 6 months. If you sign a 5-year lease, something happens, your business shuts down, you decide you no longer need that space. It's too bad. You're still liable for the 5 years of rent payments, even if your landlord finds another tenant for that building. And so you need to be very careful about the terms that are in leases. That's probably the one where we see small businesses mess up more than ever, is right there. Commercial contracts, if you're selling goods or products to people, you need to have a good commercial contract that governs any sort of dispute. Same thing with employment agreements and non-disclosure agreements that we talked about. If you're an online business, you're typically required to have privacy policies and terms of use that govern the use of your website, the use of your products or services. And then finally, shareholder agreements and buy-sell agreements. Those typically address all of those founder questions that we talked about a few slides ago around, what happens if an owner dies? What happens if an owner just wants to leave the business? What happens if they want to give their ownership to their kids? Well, maybe you don't want to be business partners with their kids or their spouse, or maybe you want to put a process in place for how to handle disputes. That's what we would typically include in a shareholders agreement. Sometimes it's called a buy-sell agreement. Those agreements just help provide a roadmap and a pathway for any sort of dispute between the owners or kind of transition between the owners. And those are recommended, not required, but certainly recommended. We talked a little bit about this. I won't go into a ton of detail here. Just know that there are different types of leases. Triple net leases are generally going to be very landlord favorable, very unfavorable to the tenant. The biggest takeaway, what we just talked about, is make sure you read your lease. Don't just sign it. If it's a 30-page document, there's probably going to be a lot of things hidden in there. We don't draft 30-page documents as attorneys because we necessarily want to. When you do, there's going to be a lot of things in there, and typically it's not going to be favorable to the small business. So really important that you read through those and have an understanding of what your lease obligations are. We talked about commercial contracts a little bit. You need to have those. I mean, that is outside of leases probably the biggest source of litigation, because many small businesses in the beginning just sign whatever the other company kind of gives you, and again, that contract's typically going to be drafted in their favor. But commercial contracts are going to help protect you around intellectual property and owning that, non-solicitation. So it's important that you read through those and don't be scared to ask for changes or revisions if there's anything in those that you don't like. We talked about shareholder and buy-sell agreements and the purpose of those. And so that kind of ends my part of the presentation. I think, Amy, we're going to hold questions till the end. So
kind of are. We've got a couple that are specific to and for you, so we may go ahead and ask them. A lot of them, of course, are around tax, and you may be deferring to their CPA. One of them is about the C Corp and are they eligible for a tax refund as an entity. I think possibly what is being asked is if you file, I think your description is probably saying you're eligible for tax deductions, but would you receive a refund if you lost a bunch of money, I guess is what they're asking.
Yes. I mean, in the same way that you can have, if you overpay taxes as a corporation, you certainly would get a refund. You have the ability, a limited ability to carry losses forward and to offset future taxes. And to do it backwards as well in hindsight, but those are very limited. But yes, we're getting into tax advice that is a much more complicated kind of conversation than I think what we need to have today. But generally, yes, you certainly are entitled to refunds and to offset profits with losses. But there's a lot of ins and outs to that.
Absolutely. Okay. LLC asking if they need to file yearly or only when the LLC starts to make a certain amount of money.
Yearly.
So,
if you are an LLC, you file once to create it, but yearly, every year afterwards, you have to file a franchise tax form, and you have to pay the $150 every year. Even if you do nothing with it, even if it made $0, you're still, the government still wants their money. So you still have to make that $150 payment.
Fantastic. Fantastic. Well, we will continue taking those. And again, we'll hold off some questions here at the end so that we can hear from Eileen in all of her wisdom, who has been diligently posting some additional comments. So we thank you very much for that, Eileen. It's awesome.
Okay, can you guys see my
We
screen?
see you, we hear you, we've got your screen. You're in business.
How's everyone feeling? It's so much information. Like everyone still want to start a business?
You had a couple of great comments about the nerve, at what people are nervous about in starting a business. Very common.
It is. Well, we as a panel just appreciate all of the participants so much. Cal, Lori, and I have been presenting 3-4 years now together, and we just get so excited to know that we have individuals in our community that have this entrepreneurial spirit and want to go out and start businesses. Cal and I are also just extremely grateful for the center and all of the great advice that they give. So I just applaud everyone for being part of this workshop, and let's just keep the relationship going. So I'm Eileen Jennings. I work for Arvest Bank almost 17 years now. I've always been in commercial and small business lending, and I have been behind the desk in Fayetteville since February of 2006. So I feel like I know the market pretty well and have seen the ups and downs and really enjoy visiting with small business customers. So I'm going to talk a little bit about the financing for small businesses for starting a business. Let's see if I can get things going. Okay, so there's a couple different ways to get this financed. You could do it yourself. You could have been, socking away all those $2 bills under the mattress, and it's finally ready. You're finally ready to put them to use. You could ask your friends and your family. There are leasing companies. Cal talked a little bit about leases to be aware of. So just chiming in on that. If there was something very specific that you wanted, like a piece of equipment or something, that's a way to do it. Bank financing, and banks can have a lot of different structures to look at, some with a SBA guarantee, some without an SBA guarantee. You could go out and try and raise some capital through people that do that professionally or want to pretend to do that professionally through venture capitalists. So, that would be like your own personal Shark Tank pitch or something. And crowdfunding. And these options are not, you don't just pick one and stick with it. I actually helped a small customer probably about 4 or 5 years ago, and she utilized about 4 of these options. So she's a bank customer, she'd been saving, she had some family money, and she also had a crowdfunding site. So that was how she got started. So some general comments. In our presentation, it really just builds on each of the presenters. So before you sign any of those contracts that Cal was talking about, please be sure that you have your financing lined up. So if you've been talking with a bank and the banker says, yeah, I think we should be able to do that, that is not a financing commitment. You need to get a letter from the bank, and you need to make sure that it is a commitment for financing, that it is not a letter that says for discussion purposes only at the top. So you want to make sure that you have a commitment from the bank before you take action on some of these other pieces. And that's just very important. So don't expect that there's a whole lot of grants out there for new businesses. I will say that locally there's been a few more options associated with emergency relief due to the pandemic, but there are funding sources at different times, but they, in my opinion, are historically not very prevalent. So I wouldn't make that assumption that, even if you're a woman or a minority, that there's a grant out there for you. Don't make the assumption that you can get a bank loan, and please don't make this assumption without talking to a banker, and please don't make this assumption and quit your job in anticipation of starting something new. So I wish I could say that I haven't seen that, but I have seen that multiple times where someone comes in and they're talking with me about a new idea, a new business, and I say, this is really great. What do you currently do? And they said, oh, well, up until yesterday, I did X, Y, and Z. And so they, we're very confident and quit the day job maybe a little bit too soon. And don't expect to get 100% financing. So we call it skin in the game. So most banks or venture capitalists, or just even grandma's giving you some money early, she's probably going to want to see some skin in the game. So you're probably going to need to have some savings. This goes back to what Lori was talking about, developing your request. Create a plan and a detailed list of startup costs with documentation. Lori and I have worked together for many, many years, and I don't like to undo her work, but I do let her know that when she's talking to customers, I'll tell customers, I'd say, it doesn't need to be glossy. It doesn't need to be in a 3-ring binder. Like, the banker wants to talk to you early. So, you've probably been thinking about this idea a lot, and a lot of that information is in your head, and a good community banker can ask those questions and pull out the information they need. So don't, I call it paralysis by analysis. So don't let this hinder moving to the next step because you aren't quite done with your plan. Those things can work in conjunction. Make sure that your plan is dynamic. So not only are you talking about where it's starting, but you're going to want to look forward. And that might seem kind of silly because you say, well, I'm starting this. I don't know, what's to come, but we're going to want to make some assumptions as far as rate of growth and are you going to, if you grow this much, are you going to need to add some employees and how does that change your expenses? And we just want to see how that all works together. You're summarizing your history in the industry. So I've seen that multiple times. I've seen long time managers of, successful restaurants or other, businesses buy the company from the current owners. And, from a bank's point of view, that we really like that because the person that's coming in really knows that industry and they also know that business really well. We have also seen people get into business for themselves, it's something entirely new. So you need to be able to talk about why this new business, why you're passionate about it and what your skill set is for this type of business. Because, there are certain skills that you can extrapolate to a new industry. And if you have a good handle on that industry, you may do just fine. You need to talk about what you're going to use the money for. So sources and uses of the funds. And then you also want to be very open with your cash contributions and what you have available for the project. Small business administration. So the small business administration is, through the government, and its goal is to help small businesses maintain and grow and for new businesses to get started. It is separate from the banks, but the banks work in partnership with the SBA, and certain banks do more SBA lending than others. Arvest is a preferred lender, and we've done SBA loans for a long time. So small business helps banks grow. They provide a guarantee to certain types of loans. And how that works is if I were to make you, let's say, $100,000 SBA guaranteed loan, like a SBA Express loan, and it has a 50% guarantee at the time. And your business just doesn't work out. And we are, you stop paying, you skip the country. We can't get a hold of you. We are able to take back some collateral. We sell what we can. And let's say out of that $100,000 loan, we're left with an $80,000 loss. And if as a bank, we handled everything accordingly and we did what we were supposed to, it's possible that the Small Business Administration would reimburse us 50% of our loss. So the bank would still lose $40,000, but would be able to recover a little bit. The SBA does restrict the allowable interest rate. I will tell you though, in 16 years of lending in this market, I have not seen that be an issue. One of the benefits of living in an area where there's a lot of growth, there's also a lot of competition between banks. And so usually the market rate of small business loans is much less than the maximum allowable interest rate. One of the things the SBA does is allow banks to stretch out the term of the loans longer, which therefore makes the payments less for the borrowers. And so something that normally the bank would want to finance over 5 years, maybe we can stretch it out to 10 years with an SBA guarantee. That's one example, and there's a lot of others. The SBA does not offer variable interest rate loans. They want the customers to really know what their payments are going to be every month. The SBA will ask or if banks and the SBA look at cash flow and collateral, and if the collateral is a little light, they are going to look at personal assets or equity that you might have in personal assets to pledge to the loan. The SBA does charge a fee. Now, I will say I'm talking about the SBA. I'm not talking specifically about the last 16 months and everything happening with PPP and some of the emergency relief loans. So some of these things are a little in flux in regards to the fees, but usually the SBA does charge a fee. That's how some of the SBA funds are generated to be able to offer these programs. The SBA is also looking at your credit history and scores, and they will require money into the project. And Amy, if there are comments or anything, I cannot, or questions, I can't see them. So just feel free to interrupt.
Yeah, no problem. I think, and I don't know if you want to take this along the way. I know that you started to address it, talking about really talking to you early. And the question is if they're hurting their chances of financing, if they go into a conversation with a lender too early, not knowing all of the info on the previous slide. So a couple of slides back. So do they need all of the information that you had listed a couple of slides ago before they talk to you, or are you a friendly neighborhood banker that but she could see how that might damage just kind of like what their knowledge is? So
in no way should an early conversation or the start of a relationship damage the future possibility of financing. It would only make it better. So I mean, so that logic is, I'll just tell you, is flawed, because you're basically guessing what the banker is going to say. So you really need to start a relationship early and get to know them. Before the call, Lori and I were talking about a customer that I talked with, and we talked for about 45 minutes on the phone, and she said, "Oh my gosh, I know I'm quiet. I'm taking notes. I'm learning so much. I just didn't even know this was a thing." And I said, "Well, that's why you call early. Let's keep talking about it." So yes, please get started early with a banker. If you do not have a community banker that you can go to, the center does a great job of. They've got they've got multiple people that they work with. They'll give you a few recommendations. We would love to see you here at Arvest. It's also, all the bankers in town know that you are probably getting a second opinion, and that is okay. So unlike Cal, bankers don't charge by the hour. So you can just talk to all of them a lot if you want.
Fantastic. We do have a question, since you did mention some of the pandemic financing, PPP loans, EIDL, and some other things. And so can you talk a little bit about, this question is specifically into the women-owned business PPP loans. There were not specific for women-owned business, but there were made a priority. There was another mechanism for women-owned and minority-owned businesses. But can you tell us a little bit about just any of those, like what is changing, what is getting mixed together, and what is kind of separating out a little bit as we're kind of coming out of this on the other side?
Sure. So I'll speak frankly. So when PPP came out, I mean, it was an interim in the proposal about taking a priority for women and minority-owned businesses, and SBA did not have a mechanism for that at all. So in non-emergency times with SBA, there is self-reporting information for SBA loans. I have not seen the only, in my 16 years of doing SBA loans, the only group that I have seen to get direct preferential treatment in non-emergency times would be veterans. as far as, some slight differences in the structure of the loans and the fees. So as an industry, so as an organization, I am not sure what SBA is looking towards. I will say that in the banking industry, there is more activity with CDFIs, which is Community Development Financial Institutes. So I think what you will probably start to see, banks are heavily regulated. And so we have to be kind of, we have to work within those regulations to keep serving customers and lending money. So I think you're going to see some of these other groups that will be able to offer like more targeted and specific financing. So I know, so there's probably a lot more. It's a complicated issue. I know that many financial institutions are really working hard to try and bridge the gap and, make sure that, are we able to serve underrepresented groups?
Absolutely. Thank you for that. And just a real quick question going back to some of the accounts that you're recommending, and they're asking if it is best to get a separate checking or a credit card account, and kind of what and where you would recommend going for that.
Sure.
And of course, Arvest, but
yeah. Well, I'll get to that in just a second because I've got a whole slide on that. So,
fantastic. Perfect.
Okay. Well, I'll jump back in. So the SBA does, in non-emergency times, the SBA does not make direct loans. In non-emergency times, the SBA does not offer grant money. Also in non-emergency times does not offer low interest loans. It also does not allow for balloon notes. Again, we want we want small business owners to really not be surprised. We want their payments to be consistent. And at the end of the loan, we want the loan paid off. Okay, so record keeping, kind of switching gears here. It's so important. I know Cal talked a lot about, the entities and getting set up and all those things, and I totally agree with him. But if you're maybe dabbling a little bit, let's say, you make the best damn cinnamon roll ever. Like it's great grandmother's recipe. Everyone's been having these cinnamon rolls. They are so good. Like people have been asking like, hey, I'm having this brunch. Can you make these cinnamon rolls? You never really thought about, charging for them. Maybe you start doing that. So if you're kind of dabbling with this, I think it's totally okay to set up a separate checking account. So Eileen doing business as Grandma Cinnamon Rolls, maybe even go ahead and get a separate credit card account for that. And and sorry, Cal, plug your ears. I mean, I know it'll be a sold prop, but you're kind of just feeling the waters, but you are going to need to keep record of those, and not only for tax purposes, but also just for you. Like how much expense did I put into those batches of cinnamon rolls? And how much did, Cal and his wife actually pay me for that? And did I actually make anything? And is my time worth $2 an hour by the end of the day? Maybe not. So, keep very good records. You can keep it on, a notepad. You can keep it on an Excel spreadsheet. You can take a wonderful class from the center and learn QuickBooks. But really try and keep good records. So keep good records of what your plans are for the business, what you're currently doing with the business, and what you're doing personally. So we are going, you're going to need to present personal financials as well as business financials for any type of bank financing. So you'll just want to keep very good records of that. And I completely agree that a good accountant will save you a lot of money. I tell people when I give recommendations for accountants to be very open and honest with the accountant about kind of what your skill level is, because I have customers and what they expect from the accountant is they collect everything in a box and they take it to the accountant once a year, once a quarter, once a month. I have people who, a lot of them started with the center and they know QuickBooks really well, and they can produce sales reports and profit and loss statements and inventory reports at, the click of a button. And guess what? Their fee is usually a lot less with their CPA. So, it just depends on what you want to do and maybe what your skill set is. But make sure you're having those conversations, because I have known people that get that bill at the end of the month from the accountant and they didn't realize they were so high maintenance. Okay. So yeah, leading into it, maintaining a separate bank account for your business. I still just see so much commingling, when I'm helping a customer with an account, like a business checking account, and there's like, $3 charges to Taco Bell and stuff like that. So that could be a business expense, but just please try and keep it separate. It makes it a lot easier. Also, if you are starting your business and you're just kind of bootstrapping it without any financing help, it becomes very difficult for the bank or the SBA to reimburse you for business expenses that went through your personal account. It's actually impossible on the SBA side. So if you say, oh, I bought this truck in my personal name, but it's really for the business, it's going to be really hard to refinance that on the business side with an SBA loan. So really try hard to keep things separate. Get to know a loan officer or small business banker before you need the money. And then, the relationship really shouldn't end there, because, I have never known a business where everything works out just the way you'd planned, or, that every day is the same. So, and a good community banker is a really good resource. They know a lot of people in town. They have, been through a couple of cycles. So they're a good person to have on your team. And that's all I have for, I did just to touch on a couple of things that Cal said to piggyback on them. So in a nutshell, how a bank looks at a financing request is we look at the project and we look at the funds needed and how much the bank could finance of the requested funds. And we see if the project itself can support the debt. So that's step one. Step two is we look at the owner or owners or ownership group, and we look at their personal financials. We look at past tax returns and their current balance sheets. We make sure that we understand the ownership and how things will be changing for them. So are they now going to be getting, needing to get all of their personal income from the new business, or are people staying employed outside of the business? What are their personal debt obligations? And then we want to make sure that those things are working together. So over the years, we've seen really great ideas, but if you're a startup business and you say that you need your starting personal salary to be $150,000 the first year, it may not work, and you don't have another source of income. So that's what we call global cash flow. So we're looking at both the project and the ownership and how those work together and making sure that we're not loaning anyone into a problem. So that being said, as an owner of the business, the majority of the banks, I'm like 99.9% sure, are going to ask the owners to personally guarantee the business debt, whether it's a conventional bank loan or an SBA loan. So just, probably some of your clients, Cal, I've had people come to me over the years and they'll say, well, no, this is why I started the LLC, because I'm not going to sign for the company. Like, I'm not going to be personally liable for it. That's why I started the LLC. So just keep those expectations reasonable, and you as an individual will, your personal financials will be looked at and you will be asked to guarantee. So. excuse me, but I mean, at the end of the day, find someone that you know or don't know, but gets recommended from someone that you do know. Start a relationship. There are so many different things. Like we at the bank really want to get you back to making those cinnamon rolls. I have never heard a small business owner say, you know what, I got into like my own business because I love reconciling my accounts at 3 o'clock in the morning. And the other thing that I really love is I love dealing with payroll, and I really love managing my cash flow. I've never heard anybody say that. So, you know, it does seem like a little overwhelming, you know, these workshops talking about the legal side, talking about the business plan, talking about the services that the center can offer. But, you know, we're all trying to just get you back to making the cinnamon rolls and expanding those things. And so, if you can put the time and effort in here at the front end, you know, really, I think it will benefit you, you know, really get you back to the cinnamon rolls. So any good banker will love to talk to you. They'll get excited. I mean, we live and work in the community where you're getting ready to start a business. Usually there's a lot of free promotion that comes along with finding a banker that's excited for you. So whatever you can do to, you know, maybe not be nervous or scared of bankers, please do it. And you have a lot of good resources on the panel. So I'm very excited about all the participants, and really excited to watch what comes of it. So
yes, and speaking of not being intimidated by bankers or lawyers or business consultants, feel free to let us know if you have any questions. You're welcome to continue to post in the chat, and Chris and I will relay those. And then Eileen, now that she can probably see her chat, Cal and Lori can answer them, or feel free to just unmute and ask what any of the questions that you've collected on the way, or something that is specific to your business. We'd love to hear, you know, anything from you, where you are, what you're doing. So feel free to do that now. You've got them here at your disposal for a little while longer.
That's a lot of great information as usual.
Absolutely. Well, you all will be getting a copy of this presentation. It does have a lot of information in it. But we want to make sure that if you have any specific questions for them that is specific to you, you guys asked some great ones along the way, great business ideas. Eileen and Cal and Lori, really interested to hear about some of the things what kind of new businesses are you starting to see open up? Just kind of lump sum, what types of businesses are starting here in Arkansas right now? Post-pandemic, are we post-pandemic? Are we just like trickling out of the pandemic? What is going on?
I post-pandemic.
Yeah, I'm seeing a lot of different things. You know, we again try and talk to people early, so you know, we hear a lot of ideas. I am kind of interested to see if two things. One, I feel like existing businesses kind of put on hold selling their business. And so I think there's probably going to be an opportunity for some, you know, established businesses to be sold to new operators in the next couple of years. And, you know, we definitely help with that. And then I'm kind of watching just on a national level with the aging population services surrounding geriatric services and memory care, and kind of secondary and tertiary businesses off of that. So having to go through some of that with my family, I feel like as a region, we're a little underserved with long-term care, secondary and tertiary businesses. So just sort of interested in that.
Agree. Lori, what's coming through the center as of late? We're getting busy.
Well, so I'm going to err on the side of caution in that it's all confidential. So I'm going to say nothing, just in case. But
It is all confidential. See,
I'm very busy and lots of people are coming to me with new ideas, and we're looking at market research, and so far things seem to be good ideas. So I feel like we're in a good, Northwest Arkansas is in a good place, and
Absolutely.
bankers are positive. So I'm feeling like much better than I did a year ago. So I feel like we're in a good spot. So I'll tell everyone that.
Yeah, see what a great consultant she is. We're posting all of those links right now about where you can become a client if you're not already. And if you are a client or have been a client in the past and your information pops up in there, you can just send us a direct email and we'll be able to get you with a consultant. Cal, what do you see, just general industry trends that you see happening with new businesses?
I mean, I'm obviously bound by confidentiality as well. Generally, I would say, I mean, it's not that much different than the types of businesses that were being formed pre-COVID. I would say, though, more and more of the types of new businesses that I am seeing are online-based, app-based, remote-based. I think it's one thing that the pandemic has, a lot of people have learned from, is that they don't all need to be in the same room in the same place. And so, in the past, I think clients would want to hire locally and build out their team locally. And what we're seeing a lot more is one employee is in Minneapolis and another employee is in Denver and another employee is in Cincinnati and the East Coast and all over the place. So I think we're seeing more of that in terms of just kind of like structuring the internal team, but not necessarily any different like industry or types of businesses than what we were seeing pre-COVID.
And I would, when you're out and about, I would ask business owners like to tell their story, because they're all different. And I think assumptions are made about new businesses sometimes about, how they got started. And, there's a lot of different ways to finance a new business. There's also some very deep pockets for certain people. And so, what you need to be an operating company to provide income for your family, I mean, also for some people could just be a hobby. And, and so it's really important that business owners talk about their origination story and ask other business owners about it. And most of the business owners I know would share. So.
Love that. That's a great tip. Well, we are excited that you all shared some time with us today, and we want to thank you again for being here. As a registrant and attendee of this workshop, again, you will be emailed a copy of this presentation, as well as a brief survey that will help us continue to serve you and bring you quality programs. Chris, you want to tell us, everybody, in addition to all those links that we've been sending them, how everybody can stay in touch with us and stay on top of all the programs we're providing?
Great. Just like Amy said, we were posting those links like crazy in the chat box, but you can find a full listing of our workshops at asbtdc.uark.edu. And you can also use the QR code right there on your screen to either sign up for notifications or to become a client. We would love to have you as a client. We are also on social media, so please find us there on Facebook, Instagram, and LinkedIn. And just like always, Amy, I always learn something from these three. So it's exciting, and I hope everybody did too.
Thank you all so much. Thank you. We'll see you again next time.
Bye, everybody.
Bye.